Yeah, so I'm now going to show you guys how I basically do my research, right? I'm going to show you that. So basically, I build this screener. So my investment universe is basically Russell 1000. So I have this screener right now. It's running on my local host. I can definitely at some point, if you guys want, I can go through the code. But yeah, right now I'm just going to go through the screener. So that's kind of like how it runs. So my investment universe right now is Russell 1000. So I have like different metrics in places, and it basically helps me. I have about like 50 signals, and through those signals, I'm able to like filter out stocks and give ratings to those stocks. So this is basically like my total score out of 100. I give to each stocks, and then that's the rating I get. I give them, and then just like I have like different signals. So I have risk signals, performance signals, earning growth again, fundamental signals. I also use like some technical analysis as well as some sentiments analysis around the stocks. That's kind of like right now Nvidia is like the highest score is Nvidia, and then again, so you can either just like download the full Excel result and just like go through these 1,000 stocks, or in this case I don't want to do that right now. I'm just gonna go through what is happening. I'm just gonna go through. I'm just gonna go through it. So right now I have Nvidia analysis, so I have the price, my score, this score basically based on all the signals. And then some technical indicators right there. So like the volatility, the Sharpe ratio, alpha, fundamental, earning growth, quick ratio, revenue growth. So those are just like some of the stuff I use basically. So you can go over here. So again, that's why I own a lot of Nvidia because again, it's like one of the highest on my screener, right? So and then I actually don't own Anet because I just feel like it kind of like falls in the same category as Nvidia. So I have it in my watch list right now. I'm just wait. I'm because like the P ratio right now for Anet is kind of like it's a little bit high. I don't. It's kind of like for me, it's just high, and I also feel like it's like 40, the P is like 49, and the revenue growth is not. It's not really like it's not. It's not. I just feel like it's not like it's basically like nothing crazy, right? So that's why I feel like I have it on my watch list. I'm looking for the P ratio to kind of just like go slightly down. Maybe also have like a higher free cash flow yield before getting to that. I also don't really enjoy the Sharpe, like the Sharpe ratio being below one and the P ratio being so high. I just feel like the risk. I just don't want to take that type of risk, right? Again, the VAR is not bad. Value at risk, it's not bad, but that's why I didn't really want. And then as you guys saw, this is fixed. So I own fix my portfolio. So fix is again it's an industrial. The P ratio when I bought it, actually the P ratio was about like 28, 27. Right now it's kind of like one above that. When you compare this to actually and then you kind of see the difference, right? So like the earning growth is of it is quite high. The revenue growth is decent. And then operation margin again, this is an industrial, so I don't expect it to be that high. I really like the Sharpe ratio. The Sharpe ratio just basically measure the risk reward. So basically your returns based on basically measure it's a basically ratio that measures like your return compared to the risk you're taking. So usually like higher than one is pretty good. As like the higher you go, the better it is. Basically that. You definitely don't want it to be negative. Like that's definitely not what you want. But this is just like a trend slope, just to know if the stock is going up and down. And yeah, so let me see what does like AI say about fix. So I also include this like AI analysis. It takes all the data I have on fix and it compares it to just figure out, is it like what's like the perfect strategy. So I mean I use this thing sometimes just when I want to go through like kind of fast. But I just don't base all my investment thesis on this, right? I just kind of like I get those like this like recommendation and I go through that, but I follow this recommendation, but not every time. So you can reach this recommendation right now building comprehension is yeah. You can basically just like go through this and figure out what I want to do, and then another stock I own, yeah, Accent's actually also on my watch list. PWI is also on my watch list. Deck, yeah, this is Deck. I also own Deck. Let me see the score. So Deck score is 73. Yeah, 73 is still pretty good. Again, you can see the revenue growth is quite nice. Earning growth is actually amazing. Operation margin is quite good. We gotta realize that Deck is a retailer. The Sharpe ratio, it kind of like went down when I bought it before. It was at around 1.1, but the alpha is pretty good. The beta is pretty low. I like that, and then the value at risk is great. The trend slope is not doesn't look good. So basically, again, the stock has been going down. The chart is not showing yet, but yeah, the stock has been going down recently. So that's just like, this is actually the chart. So if I kind of like just like zoom in, let me just zoom in to the last Just I mean, it's kind of like see how the stock kind of just like peaked. You can see like the stock kind of just like peaked around. No, actually, I think it peaked before that because they had an earnings. I remember that they had an earnings. Yeah, the stock kind of peaked around here. So it was like June 3rd. It peaked at about like 180, and then since it's just kind of just like be on the downtrend, and then it hit the 200 moving the average right here, bounce back. So you can see like the resistance level right here, kind of just like went down, hit it back, went down, hit it back, went down again, and then you have to see like again. So kind of just like it hit the 200-day moving average, simple moving average here. Well, that's kind of like yeah. So this is just a line that should help me kind of like again figure out you know, the basically like how the stock move, right? All this is taken into consideration into my screener. So that's why the is not ranking as high so you can see like it's the 200-day moving average goes back up, and then what's going down has just been recently just like yeah, going through that. I still on that. Uh, I noticed I want to go to maybe like Celsius here. Let me look at Celsius. So as you guys see, I apply multiple strategies. So basically, I always just felt like one of my professors always says like the best strategy is to apply multiple strategies. So that's like something I just kind of like always keep in mind. So I apply multiple strategies. So I in my screener I apply the fundamental strategies. So going through, so I basically just like pull out all the data from uh financial statements and I use that in my screener. I also take data from like risk assessment. So different ratios to measure the risk adjusted to return on the stock. I also take some technical indicators, so trend slope, RCI, SMA, AQR. I also take sentiment analysis. So basically, like it's a stock, basically like I just go through the different news and I kind of just like, have this like machine learning algorithm that goes through news and figure out what is being said about the stock. Is it a positive news, a negative news? That's kind of like, and I just have like, uh, I just apply this model that helps me optimize the weighings basically. So this is Celsius, so the Sharpe ratio is pretty great. The revenue great again. That's why I was like, again, that's what I was saying before that the fundamental for Celsius looks pretty good. Like revenue growth is pretty good. Earning growth, amazing. Operating margin, I would say above average. Sure, the P ratio is. I feel like the P ratio is still high, but again, you cannot just like measure a stock based on the P ratio. Again, so the trend slope is quite low because again, the stock has been on a downtrend as you guys see right here. So it peaked out around here and it's just like been going down. So I should have recognized that because I remember when I was buying this stock, my mother was telling me not to do it, right? But I was just kind of just like, I was being stubborn, but I still bought it. I don't regret buying it, but again, it broke through, this is like the 15-day moving average. This is the 20-day moving average. So we can see like it hit right here. It was around March. It was a 96, up and on $96, high was 99, low was $92, close at $93. So it went there, went down, went back up, and then just like there was just like a massive sell right here, and then it just like kept going down. Yeah, I should have, when I saw that, I should have known that something bad was gonna happen because usually when the stock breaks the 200-day moving average, it's usually a bad sign. So it broke through here, and it just like just been falling off, falling off, falling off, falling off. Because again, when you go back in the past, you can always see that it usually just like bounce back here. You have a small break, but just bounce back, small break, bounce back, bounce back, bounce back. I can even scroll back. You basically see like some usually does happen. You really see like always like this like kind of just like tripping, bouncing back, but right, it's just like broke through and then it's just been like crashing down. Yeah. So right now again, I'm just still holding it. I'm not really in a hurry of selling it anything whatsoever. So we have some AI analysis right here, and then long-term investment. But the short term is not really again. If you're a short-term trader, you should not really be holding. You should not really be holding stock. Again, same for income investing. That's not where you want to be at. And then value investing again may not be where you want to be at. So that's one of my, yeah, that's kind of like my screener. That's like how I do my most of my stock research here. Because again, I don't have time to go through like 1,000 stocks, and I use this screener just like, again, a faster way to analyze a bunch of stocks, right? So again, right here, I don't own all the stocks in the top 10 because again, I kind of was like, it helped me filter stock, but at the end of the day, I still have to like do some like research after that, right? Just help me filter instead of having to like go through 1,000 names. I can just go through maybe like 20 names, like the top 20 stocks on my screen. I can go through those 20 names and just like figure out from there. That's one of the stuff I have. When I want to like go deeper into the analysis, so I can go to risk analysis and maybe again type SLH. So again, Celsius Holding, description, the company of fitness drinks, yeah, e-commerce website, founded in 2024, Florida, consumer defensive, beverage non-alcoholic, volatility 75, which is this volatility is quite. I'll probably this is probably the only stock I own which is such a high volatility. Even the value at risk is also, yeah. Again, as you can see, it's a quite risky stock, right? So when I bought it, I knew I was getting on because again, I saw this risk when I went to the risk analysis. I saw all of these, and I was like, I still went through that, right? But again, the beta is a quite high beta. But again, but the Sharpe ratio is again pretty good, right? Because usually it takes about like this amount of days for the stock to recover. So you can see right here the stock hit was at its highest over here, right? So that was May 15, and then it's just been going down, going down. It's down about 65% from its highs. So it usually takes about like 195, 85 days for it to come back. So hopefully it follows this trend this time. So the information ratio rate is actually good, and then correlation with the market. Mm, so it's okay, like nothing crazy. Trainer ratio, Fortuna ratio, correlation return. Uh, let's look at NVDA, just so you guys should see the difference. So NVDA again, you can see, if similar for NVDA, NVIDIA, graphic power compute, Taiwan, China, Hong Kong International, semiconductors. The volatility again for NVIDIA is quite high, 53%. It's quite high. Value at risk, you know, same, quite high. The CVAR is also high. And then you have the beta, which is quite, I would probably say it's like really quite high. The Sharpe ratio is pretty good Sharpe ratio. The recovery time is a little bit, what, 2 times longer than Celsius, but all the other ratio, the correction in the market is quite high. This basically means that, whenever the market goes up, the 70% chance of NVIDIA going down, right? Whenever the markets go down, the 70% chance of like NVIDIA going down. So the correlation in the market is actually quite high there. And then alpha information ratio. So Nvidia actually recently had it hit. So in July 10, that was the maximum, and then it kind of like went down, went back up, went down again. So it's just been trading kind of like in this like weird way recently. Basically that this is just like the box value 10 for Nvidia. Uh, so if I look, let me look at another stock. Uh, I don't know what it's actually. I think it's APL. I may be wrong actually. I'm not sure. Oh, App actually APL. And see, Apple is actually a little bit less volatile. Again, the risk is like lower than again Nvidia. Correlation with the market again, because like those are like $3 trillion companies, right? So they have a high correlation in the market. Usually, like when Apple is down, the market is down. That's usually what happens. Because if I look at a smaller stock like FICO, probably has a lower correlation because like it don't have wow. See also, I'm surprised actually. That's has a high correlation with the market. Then FICO is also quite a volatile stock. Again, the Sharpe ratio is. I usually like it above one. That's really what I like. FICO again, you can see like FICO is usually a stock that doesn't really like. Whenever FICO dips, that's really bad. Like frankly, like again, if I go back to November 16, 2022, usually whenever FICO dips, as you guys see right here, usually just go back. Whenever it goes dips, it just like goes back up, go back up, go back up. Again, when you go back in this is like COVID crisis, went really down, and then it took like from year to year to recover. So this is probably just like 328 days, and then maybe just one more stocks to go through. Something I own. I'm gonna with actually, yeah, I'm gonna go with Fix. Fix is another one. Again, really nice sharp ratio. Recovery time again, similar for Fix. Whenever it usually does that, usually buy right there. I don't want to zoom in, but uh, yeah. So that's pretty much it. industrial engineering construction. So you can kind of like just like read the description of fix better, what they do, provide mechanical and electrical installation, all like what they do. Then again, I kind of go through new sentiment analysis, just like fix, and they're gonna give me a basically like sentiment score for fix, so 0.5. And then I get like the news links for fix, so you have like different news here for fix. So sometimes again, if I want to do a quick research on my stock, right, I can just like type my ticker right here and just like get links to articles about my stocks. And also like, sometimes just like see at what analysts say. So as you guys see right here, fix is not that much covered by analysts, right? So it's, yeah, it doesn't really. So you see like what is being said about fix. Overall, I know the news is positive because I see it right here. But if I take another stock, maybe I don't know which stock is being Boeing actually. Boeing is a stock that's based not being in a good. I don't know what is it B or I'm not sure. I'm not waiting for B. But no, that's not. What is Boeing? Maybe it's BO. Nah, I could definitely. Let me just look it up. I could definitely look what Boeing is. Boeing. Give me a second, guys. Just figuring out. Oh, it's B actually. Yeah. You see, like Boeing, for example, the sentiment is like negative, right? So I kind of like know that the stock has not being in a positive, right? So without even having to read the articles, I already know that this is bad. This is bad news. Usually when it's negative, it's actually extremely bad. So you have Boeing Defense chief exit company, the head of Boeing Defense space out of the company, tries to fix travel contracts. Boeing 752 local experimenter for the workers preserve cash. A strike at Boeing. Yeah, usually just like based on the title again, pretty much just like bad news. And then you have like the ratings on the weight, price drop, hold, drop. Yeah, so and finally, you have the optimization case. I don't use this as much. I have a specific script that I use for my optimization. Again, because like I always try to balance my risk. So right now, I have all those weightings. I usually try to rebalance once a month because I don't. I try to rebalance always once a month. So basically, just run through all of this like analysis in one of my scripts, and it's gonna give me like the best exposure for these two basically like have the highest Sharpe ratio and also just like have the lowest risk possible. So I'm just gonna go run through my optimization case and figure out what is the best weighting for my stocks. But I can go through just like a quick example of how you guys will do it. So yeah, I could also upload a CSV, but I just don't want to do it now. So CLH NVDA fix and maybe just FICO. I'm just gonna stop there. I'm gonna try to analyze that. So when you get this, basically say that like it was not able to converge with solution. So I have to increase the volatility. Yeah, it's not able to converge with solution. All right, it was able to converge with solution right there. So maybe let me try to lower the volatility. Actually, let me just leave it there. So right now it converge with solution. So with a volatility of 32%, my expected return will be this. So if I follow this weighting. And then again, this is based on past data and also based on my current analysis that I showed you guys before. And this will be my Sharpe ratio, and yeah, this will be my Sochner ratio. This will be my beta, and then my alpha, just an alpha, and this kind of the volatility for each stock. So Celsius, FICO. So you can see like most of the volatility comes from Celsius, and then you get in terms of information ratio. Most of it comes from FICO and Fix. So based on that, I can also adjust. I can maybe be like, all right, I don't want to have Celsius here. I maybe want to have which other stock can I be using right there? Let me see deck. Instead of Celsius, I want to have deck, right? So let me rerun this case. So now that I included deck. So now I have deck, so I can see like my volatility. I can maybe just like decrease my volatility a little bit and see what happens. Let me try to increase it. So now my Sharpe ratio is 1.9. Let me see what happens here. 1.9.1. I actually get a better Sharpe ratio at 31. So this is my value at risk really happy. This is actually, trust me guys, this is actually really, really good value at risk though. So basically this is basically saying that if I had follow this weighting from if I had followed this weighting, this is basically gonna be my annual return, my volatility. Trust me, guys, this is actually extremely good. This Sharpe ratio, I'm pretty sure like even like some hedge funds can get it. So that's again, that would be the case if I could read the future, right? But this is just based on like past data and basically me trying to like figure out what's gonna happen based on like my analysis, basically that. So again, I can see like the annual the volatility, yeah, the volatility mostly come from Nvidia now, and the information ratio is still like yeah, deck fix and FICO actually has a pretty good one, and the tracking error is quite small, 0.0, yeah, it's quite small, and then maximal drawdown, yeah, Meta is quite high with Nvidia also, and then this is like efficient for change. So basically, efficient for change helps you measure at what point in time doesn't make sense to take more risk, basically because at some point like taking more risk doesn't increase your return, right? So as you guys see, at 0.25%, there's a standard deviation of 0.25%, right? Your return can just like get maxed out at 66%. That's kind of like how it gets maxed out. The reason why you see a difference here is because on this optimal portfolio allocation, I set up in a way that every stock has at least 5% in it. So I have like a minimum of 5% in each stocks. So that's why it's kind of like going like that. But I don't know if I can go lower doing that. Yeah. So I guess the lowest solution is 30. Is 30%. Yeah, 30%. You can see like deck is now. Yeah, and then you have basically made FICO is actually out. So the P ratio is actually not great. So maybe let me see. 32. Yeah, it seems like 31 is definitely the optimal case. I guess the high share ratio is 31%. So